In May 2026, the most financially powerful job in the country quietly changed hands. The new chair of the Federal Reserve will influence your mortgage rate, your savings yield, the cost of your car loan, even your job market. Most people couldn't name them. Let's fix that and understand exactly how much power the job really holds. Jerome Powell's term as chair ended in May 2026. He didn't leave the building, he stayed on as a Fed governor, a seat that runs to 2028, but he passed the gavel. On May 22nd, Kevin Warsh was sworn in as the 17th chair of the Federal Reserve. A new hand now steers the institution that sets the price of money. Here's the most misunderstood thing in finance. The Fed chair does not set interest rates by personal decree. Rates are decided by a committee, 12 voters, and the chair holds exactly one vote. What makes the role powerful isn't the vote, it's influence. The chair sets the agenda, builds consensus, and, crucially, chooses what the Fed signals to the world. Markets move on the chair's words long before any vote happens. Warsh has signaled a particular style, leaning toward keeping markets guessing rather than spelling out every future move. That matters to you. When the Fed clearly telegraphs cuts, mortgage rates can ease in anticipation. When it stays deliberately vague, markets hesitate. So the chair's communication style alone can nudge the rates you'll be quoted before a single decision is made. To feel the stakes, look at the range. Since 1971, the Fed's benchmark rate has averaged around 5.4%. At the extremes in the early 1980s, Chair Paul Volcker cranked it all the way to 20% to strangle runaway inflation. Brutal, but it worked. And in December 2008, during the financial crisis, the Fed slashed it to essentially zero. Same lever, wildly different settings, each one reshaping mortgages, savings, and jobs for years. Here's the mechanical path. The Fed sets the rate banks charge each other overnight. That ripples into the rates banks charge you, credit cards, auto loans, and indirectly mortgages, and the interest they pay you on savings. Raise the benchmark and borrowing gets pricier while savings finally pay something. Lower it and loans get cheaper while savings yields sink. The chair's tone sits at the very top of that chain. None of this is a cue to time your loans or accounts. It's just how the plumbing works. You don't vote for the Fed chair, but the job shapes your financial life more than most elected offices. A new chair means a new temperament at the top of the money machine. Watching how Warsh talks, not just what the committee votes, tells you where rates may drift. Money. Unwrapped, where we explain the levers so you can read the room yourself.